Hey everyone, Michael here. So in this video, we're going to go through the dividend section of the company report, and I'll explain to you the metrics we check and why we check them, and then I'll share how you can gain some insights from the particular charts and graphs that we have in this section. So why is it so important to assess a company's dividend? Well, ultimately, if you're looking at this, you might be a dividend investor, and as a dividend investor, it's very tempting to just look at a company's dividend yield and invest in the highest yielding stocks. Now, I hate to be the bearer of bad news, but that's a very bad strategy because ultimately there's these things called yield traps, and they refer to stocks that have a very high yield that is unsustainable. And these situations arise when a company may be paying a dividend and all's going well, and then all of a sudden some news comes out where, for example, the share price collapses for whatever reason. It might be the future expectations of earnings have deteriorated, some news has come out about the doubt of the company's ability to pay dividends, or some big, huge one-off expenses, or just some sort of issue that has caused the company's share price to collapse. And so that consequently drives the company's dividend yield up because the dividend yield is backwards looking in regards to what it has paid in the past year. And so if you've got a situation like that, you may be thinking, oh yes, a 10% yield on a dividend, that's on a stock, that's great. But ultimately then it's not actually forwards looking. It's like, well, that 10% is not going to hang around long. Like the company might end up slashing its dividend. So those are the kind of traps that you want to avoid. You don't want to just filter for the highest yielding stocks and invest in them. You want to look at a company's dividend yield, like how it compares to others in the market, which is what you do in the first place, but then you want to also look at its reliability and its sustainability of actually being able to pay those dividends. And that's what we do here in this section of the company report. So like all the other sections, we have 6 metrics that we check, and I'll go through them now. So the first 2 we check, like I mentioned, are in regards to the company's yield. So this first section we have here is basically, well, we show you first of all what the company's yield is that you're looking at. And then with these 2 metrics we check here, we compare it to the market that it's in. So here you can see the first check we do is, does the company even have a notable dividend? And what we mean by that is, like, is it above the bottom quartile of dividend payers in that particular market? And in this case, it's not. This yield of 0.7% is actually lower than the bottom quartile of dividend payers in the US, so the company doesn't pass that check. And what that basically tells you is that this yield isn't even better than the bottom quartile. So it's telling you that there's better opportunities out there in this particular market. And so if you're a dividend investor, that might be a sign to go to the screener and filter for stocks that are yielding higher dividends. The next check we do is pretty much the same thing, but it's up the higher end, right? So we check if the company has a high dividend, and that is basically checking if this dividend the company pays is yielding higher than the top, or within the top quartile of dividend payers in that particular market. So is it above 3.5% in this case? And ultimately that's to tell you, if it does pass that check, it's basically to tell you, like, this is a top yielding stock, like it's got a very impressive yield compared to the market. But in this case, again, it's not passing that check, so we can tell that not only is it not the highest dividend payer, it's not even high compared to the lowest quartile. So this here tells you that there may be better opportunities out there within this market. And now this isn't a metric we check, but we do provide 2 additional pieces of data here. So we compare it to the industry average yield, and in this case it's the software industry. And we also show what the analyst forecasts are, the consensus forecasts are, for the dividend yield of this company in 3 years' time. And the reason we do that is to just provide a bit more context. So here we've compared it to the market, but we also want to compare it to the industry. So what we can see here is that it's actually pretty much on par with the industry. And that tells you that, okay, while it's not a high dividend yield, maybe it's just because it's not in a high dividend yielding industry, being the software industry. So if you are a dividend investor, that might be, okay, software maybe isn't the best opportunity for me. If I do want a high dividend yield, I should go to and look within this market and see what other industries are out there that might be paying more. So it tells you it's on par with dividend payers in the software industry. So that's pretty standard. And the next thing we provide, as I mentioned, is the forecast. And this is just to give you an idea of, okay, if analyst forecasts come true, what could the stock be yielding in 3 years' time? And this tells us here they reckon the dividend yield will increase a tiny bit, and this is based on the likely expectation of dividend increases, right? So they don't necessarily predict where they think the share price will be, but they do predict what the dividend yield will be based on the the future expectations of dividend payouts. So they expect dividend increases a little bit in the next couple of years, and not a huge increase in yield. You want to look at this and compare it to where it is today, and ultimately if they think the yield will be lower, you want to you want to then look further down the report and assess why. Do they think dividends are going to drop in the future? Or if it's going to be higher, do they think dividends are going to increase? So that's something to keep in mind here, whether or not they expect it to improve. Now, the next check we do is about the stability and growth of payments. So here we have two metrics we check, and like I said, it's just the stability and the growth of payments. So this chart here is full of data, and there's a lot of interesting insights you can take away from. So before I get to that though, the first two metrics we check are the stable and growing. So the first one being stable, basically, has there been any dividend cuts in the past 10 years? And the reason we check for that is ultimately if a company has a history of at least cutting the dividend once, cutting the dividend at some point in time, then what's to say they won't do it again in a time of a temporary decline in earnings or temporary sort of hardship, whatever reason. What's to say because they've cut it again that they won't do it before, that they won't cut it again? So we check for that. We want to see if they've been reliably paying it over the last 10 years. And in this case, the company, as you can see, it hasn't cut the dividend once, so it passes that check. It has proven that we don't have to worry about it being, or we have more certainty about it not being cut, considering they've been consistently paying it over the past 10 years. Now, the next check we do is in regards to the growing dividend. So basically, has it increased over the past 10 years? And in this case, you can see the company has increased it quite a bit from 64 cents to $2.48 per year. So amazing growth. Reason we check this is because ultimately you want to be investing in a company. If you're investing in a company that for its dividend, you want to see that it's been able to increase its dividend, meaning it's also able to do that. In order to do that, it's been able to increase its earnings. So the reason we do that is because you want to know that it's not a stale business that's basically just passing off cash flow and it's not growing. You want to know that it's basically able to continue the increases. And as you can see here, this part to the right here is actually analyst forecast, and they do expect the dividend increases to continue. And if you relate this back to the future growth section, you can see that they also expected earnings to increase. So this is basically a subsequent sort of increase. Like, therefore, because earnings are expected to increase, they therefore think the dividend is also expected to increase. So that's a good sign if that's what you're looking for here. Now, in terms of analyzing this chart, there's a lot to take away. First of all, like I mentioned, you can see that the company has consistently and reliably been able to increase its dividend. So this teal blue line is the dividend payments per share, and they're annualized figures rather than annual. So annual dividends are basically like backwards looking, whereas annualized dividends are a good proxy for like forward looking payments. So that's something to keep in mind when you're looking at this chart here. And as you see this teal blue line, it's basically giving you an idea of how the dividends have been changing over time. Now, an important thing to compare it against is this purple line here, which is earnings per share, trailing 12 months. And you can see here, you may look at it and think, oh wow, like the dividend per share is like $1.24, but the earnings per share are less. When in actuality, because of the way this chart is set up, you have to hover your mouse over the earnings per share to actually see how it compares, right? So here we can see the dividend per share was $1.24, and you may think, oh wow, earnings per share is lower than it, but you hover over and you see it's $2.42. So it's almost like a 50% payout ratio back then in 2015. So this, by hovering your mouse over this whole period of time, you get to see how the dividend payment has changed in relation to earnings per share, and it's a really key insight to take away of just how the payout ratio has changed. The next thing I want to touch on with this chart is the yield. So this blue line here refers to the company's dividend yield. And you can see here it's basically been trailing downwards, and you may think, oh, that's bad. It's been trailing down to 0.7% when it used to be 2.6. Now, the thing that I want to stress here is this is because the price has increased so much that the yield has decreased, right? So you can see that the dividends, like the underlying business is solid in this instance. Its dividends have been increasing, but the yield has decreased. And if you compare that to the company's share price change over the same period, it's because the share price has appreciated significantly. So as dividend investors, what you want to think about is, okay, let's look at it this way. Let's say I'm here, back in 2012, I was looking at this stock and it was yielding 2.6%. That's pretty decent. And if you were analyzing the company back then, and you're like, okay, earnings are expected to improve, dividend payments are expected to improve per year, so you buy some shares here at a 2.6% yield. As time goes on and these dividend payments increase, all of a sudden when you were receiving 80 cents per share here on your stock when you bought it, all of a sudden you're now receiving $2.48. So almost basically 3 times the amount of dividend yield you were receiving back then. So you're almost at like 6%, 6 or 7% here on a dividend yield on what you paid back then. So if you bought this stock, you're now receiving actually quite a high dividend yield because the company's earnings have improved, its dividend has improved, and your initial cost base is from all the way back here. So that's something really important to consider when you're looking at a dividend. Like, yes, it's important to be backwards looking and see how the reliability goes. But in terms of looking forward in the future, if you expect the same sort of thing to happen, the dividend per share to increase, then that means this yield is right now what it's paying. But as I mentioned, it could be higher in the future if that trend continues. So that's something to keep in mind for this particular section. Now, the next part we do is basically in regards to the sustainability of the payments. Like I mentioned, that's the third part we check. And this is in regards to the current payout ratio that the company employs. So you can see here in the visual, we have basically this whole circle represents a dollar of earnings that the company has generated, and it shows us how much they pay out of it as a dividend. So in this case, the current payout ratio, we want to see how well the company's covering its current dividend in regards to its earnings. And so we can see here that it's actually only paying out 26 cents for every dollar of earnings that it makes. It's choosing to retain 74% of it. And what that tells you is basically, okay, they're choosing to allocate a bit of the earnings out, and they're actually choosing to retain quite a large portion of their earnings to reinvest in the business. And now the reason why we assess a current payout ratio is because we want to see if, say, some event comes up like a short-term speed bump and their earnings decline quite a bit. We want to see if the dividend would be at risk, right? So say earnings declined in this case by like 50%, then all of a sudden the payout ratio increases by 100% to like 50-50, and that means the earnings are still the dividends are still safe, right? Whereas if the company was currently paying out like 90% of its earnings, right, as a dividend, and then all of a sudden earnings declined, then all of a sudden the dividend's at risk and it could be cut. So we want to see that the company is choosing to employ like a sustainable sort of payout ratio where it's like not at risk of any short-term volatility in regards to the company's earnings. So this we can see is a great conservative ratio, and it's good to see that it's not too high in terms of being like a dollar for dollar in terms of $1 of earnings and like almost $1 of dividends. So they have some wiggle room. And the next thing is the exact same check, but in regards to the future. So this is based on what analysts expect the company to be paying dividend per share in the future, and also what the company is expected to be earning in the future. And we can see here that it's actually expected to decrease a couple of percent to 22%. So this tells us that they expect earnings per share to increase more than the rate of the dividends increase, which is great to see. Like not only are the dividends able to improve, but they're actually becoming more conservative in their payout ratio. So that's a great takeaway here. And as I mentioned, it still means they're retaining like 78% of their earnings and they're reinvesting in the business. Now, this is something to keep in mind, because if you've got a company that's choosing to retain quite a large portion of its earnings, ideally it's because they have they have projects that they want to invest capital into to reinvest in the business and generate high returns on capital to allow them to increase the dividend in the future. Because ultimately, if you've got a company that's choosing to pay out 90% of its earnings, well, then it's not reinvesting in itself much, and therefore its ability to increase its dividends might be a bit more limited compared to someone who is consistently reinvesting in themselves and improving their potential to increase their earnings in the future. So if you're looking at a company that has a high amount of earnings retained like this, what you'll want to compare it to is the return on capital employed and the return on equity up in the past performance section, and just see if it's actually allocating it in profitable areas where it's generating a good return. And also in the future growth section, you want to look at what the company's future return on equity is expected to be, because that gives you another sort of insight about this as well. Like if it's retaining those earnings to allocate it into profitable initiatives. Because ultimately management teams have a decision. When they earn some money, they can either reinvest in themselves or buy back shares or pay a dividend, and it's their job to allocate it the best way possible. If they have really high rate of return opportunities internally, it makes sense for them to do that. If they don't have anywhere good internally to invest, or they've got enough, just like this company, 74%, then they can pay out the remainder and be like, okay, we've got everything we need. We can return this excess money to shareholders. So that's something to keep in mind as well. And the final part I'd like to make before telling you what the next steps are is basically, if you're a dividend investor, obviously you want to see some sort of checks on this snowflake. You want to see that the company has some sort of score. But if you're not a dividend investor and you see that this company has scored 0 out of 6, that's not necessarily a bad thing, right? Because just like I mentioned, there might be a company where it's like, it looks at it and it's got some earnings and it's like, we have incredible reinvestment opportunities internally where if we invest now, we can then potentially pay a dividend in 5-10 years time, right? So we've got a huge opportunity in front of us. We need to reinvest in ourselves to either gain market leadership or increase our competitiveness or just get some market share, whatever it may be. So if you see a company that has 0 out of 6, it may be one of those. Like, for example, at the time of this recording, Amazon and Facebook don't pay a dividend. And that's because they're constantly reinvesting in themselves because they have so many internal opportunities to allocate that capital at really high rates of return. So just keep that in mind if you're looking at a stock, not necessarily from a dividend perspective, but if you see 0 to 6, it's not necessarily meaning it's a bad stock. It just means that because they don't pay a dividend, they don't pass any of these checks. So now, if you're a dividend investor and you've just gone through a dividend part of the company report and you think, first instance, let's say you think, this is a great stock, you'll keep looking at the company report and go through and assess the rest of the areas. And then if you like the stock, you can add it to your watch list or look at when their upcoming dividend is and just keep an eye out for that. But alternatively, let's say you went through this dividend section, you're like, no, it doesn't seem sustainable, it doesn't seem reliable, and it's not the highest yield. I want to see what better opportunities are out there. What you can do is at the bottom here, we have next steps, and you can basically click this, and we'll show you other opportunities within that same industry that have a good dividend score. So you can see from this list here that's about to generate that we show all the other companies in the software industry that are paying a dividend, and we show you all the different stats. So how large they are, analyst price target or analyst targets, valuation, their expected growth of earnings, and their dividend yield. So you can scroll through here straight away, and if you want, you can also choose the grid view, and you can look at these companies' snowflakes, and you can see straight away, oh wow, these have some pretty good dividend scores. These are probably worth my while. So since you're in that industry, you can then go into these and do the same sort of analysis when you look at their dividend checks, and then try and get an idea of if they're also sustainable, reliable, and like a good dividend yielding stock. So yeah, that's pretty much how you use the dividend section of the company report. I hope that's been helpful, and thank you so much for watching.